Good morning, everyone. My name is Tish Crawford-Jones, and I'm a director at Q4. I help lead our EMEA customer base. Thank you for joining us today. And before we get started, I just wanted to be able to thank the IR Club Schweiz for partnering with us today on this webinar and the content. So thank you to all of that team. And a little bit of housekeeping before we start. Should you have any questions that you want to be able to ask us as we're going through the presentation, I encourage you to pop these into the Q&A tab, and we will be able to collate those and then look to answer them at the end of this session. So for those of you who are less familiar with Q4, we're a leading provider in IR operations within our IR platform. We support public companies globally with their websites, IR events, CRM, shareholder ID, and analytics. And our deep understanding of IR challenges is exactly why we're so focused on innovation, particularly how AI can help IROs work smarter, not just harder. So we're seeing this shift in real time with the introduction of some of our latest AI products, and we have an AI agent that's built into our Q4 platform. And many teams are now unlocking capacity to focus on higher value activities like strategic targeting. So we recently conducted a total economic impact, which is like a TEI study by Forrester Consulting, to prove the measurable IRO of our platform. And that aims to educate IR teams and strategic decision makers on the tangible business values and using a credible third-party research source. The quote here on the screen is from this case study. So we can be more strategic, and this is from a client of ours. We can be more strategic because I'm not caught up doing the recurring or more tedious work. We can take a step back and ask how we can impact the business and actually drive higher shareholder returns. Now we're doing targeting for the first time ever. In the past, we just met with whomever sales told us to meet with, but now we have the bandwidth opened up to make sure we're meeting the right people. So this is the kind of impact highlighted throughout the report that we have, where IROs shared how AI is freeing up valuable time to focus on more strategic initiatives. And that brings us to why we're here today, to dive deeper into one of those key opportunities, targeting the right investors with greater precision. So today we're lucky enough to have Sandra Novikov join us today. So thank you so much, Sandra. Sandra is a senior investor relations advisor with 25 years of experience guiding companies through evolving capital markets. Sandra, I'll let you introduce yourself.
Thank you, Tish. I'm delighted to be here. So I started my career in IR advisory back in 2000 and have since had the privilege of supporting more than 100 European companies with their investor relations. And looking back, our industry has seen considerable change in the teams, as many of my clients have become much smaller. The scope keeps expanding. They're dealing with more and more each year. So much of my work focus today is on how companies can take a more strategic approach to investor relations. And this is particularly relevant when it comes to investor targeting and engagement.
Thank you, Sandra. Okay, so let's dive in. So effective targeting starts with clarity. Defining your ideal investor profile ensures your outreach aligns with the investors most likely to believe in your story and strategy. So here on our first slide, we cover off how your company's story fits into the market to consider market capitalization, growth stages, industry sector. You've got ESG in there, and of course, your location and your geography as well. So Sandra, when you're working with IR teams on defining their ideal investor, what's the most common blind spot you see something even seasoned teams often miss?
I think the one thing I see very often still is people getting very focused on defining the ideal investor by investor style. So, they'll look at whether, they want to attract growth investors, long onlys, whether they need some hedge funds. But in all this, they forget to look at behavior and some of the more specific characteristics of each investor. And I think this is where talking to some of your existing shareholders can really help you understand how you come across and why people hold the stock. So, is it for index exposure, for conviction in your strategy as it trades? I think your existing shareholder base can give you a lot of insights into how you should be thinking about the markets and the ideal investor for you. And I think once you understand their motives, not just their mandate, then targeting it becomes a lot more precise. Also, I think these styles are not static. The behavior evolves. So, we've all seen, how hedge funds, for example, have changed over the years, and, what we used to think of them of, doesn't hold true for many of them today. So what I would say is every time you meet an existing shareholder or even potential shareholder, set aside 5-10 minutes of the meeting at the end to ask them about their investment approach, how you fit into that, how they're looking at the market as a whole, who they compare you to as well. And I think that's sort of one side to it. I mean, the other side is narratives evolve, and I think when it isn't a sudden change, a big restructuring or an M&A transaction, sometimes companies themselves realize slightly later than the investment community that their profile has changed. So, has your growth slowed down a bit? Has your geographical exposure changed? Is your dividend yield getting more attractive or less attractive? I think looking at all of these gradual changes on a regular basis and then thinking about what they mean for how you're perceived by the investment community.
And I think you raise a really good point there about the feedback piece as well, because we all know that there are a certain number of investors that don't give feedback to maybe the brokers that we work with. So setting aside that time at the end is really important. And as you've just mentioned, you can actually throw in some other deeper questions that can help you with the targeting piece as well. So I think that's a really interesting point.
And I think this is what we hear from investors themselves. I think a number of fund managers who I've seen at conferences over the last couple of years have made that point to say, we're happy to tell you, just ask us.
Exactly. So, and then you mentioned obviously the point about maybe, your operations have changed globally as well, thinking about the geographic part. So, what's the best way to reconcile a company's story with different priorities investors maybe have in Europe versus US and maybe Asia as well?
I think the core story obviously shouldn't change, but I think your entry point does. So I think I'd like to think of it as sort of, reading the same book, but maybe starting with a different chapter depending on, who you're reading it to. So I think naturally you assume a lower level of familiarity with your company, your market dynamics amongst international investors. They may also have a different level of emphasis on different KPIs. So for example, US investors, at least today, seem to have less of a focus on ESG and your sustainability narrative versus European investors. Asian investors are, maybe more focused on the partnerships you have in the market. So I think understanding some of that really helps, but also I think you have to start with the education piece. So, you think about your market dynamics, the governance, your regulatory frameworks. Just think about all the things you take for granted when you speak to some of the investors that are more local to you. Another way to think about this is how you would adapt your narrative for a retail investor. And I think if you put in any effort into trying to make it more accessible to retail, think about some of the lessons learned from that and some of the things you can bring into how you communicate with institutional investors and particularly international investors. And I think that could be a very helpful exercise for both retail and institutional targeting.
Thank you. So now we've looked at the story side of things, and now to build an effective targeting strategy. So it also starts with understanding who already owns your stock. So analyzing your current shareholder base provides a clear picture of where you're strong and where you may have untapped opportunities. So when you're looking at who owns your stock already, you can obviously identify your top institutional investors, as you've mentioned, and their strategies. You can segment them by active, passive growth, value, etc. And then you can start to detect those gaps or those concentrations. Are you over-reliant on ETFs or underrepresented in, long-term active funds? So Sandra, when we're looking at the current shareholder base, what insights do you think are most valuable for shaping future targeting beyond who's already holding their stock today?
I think there's, all the things you mentioned that are set out on this slide, but there's also sort of looking at who's watching. So all the engagement data you might have, webcast attendance, website traffic, social media engagement, your own meeting notes and CRM tracking. All of this will help you understand who's maybe circling the story more actively and where the opportunities might lie. I think also getting some feedback from existing and particularly, your former shareholders to understand why they sold and, how you're being perceived, whether there's anything you can do about it. And I think outside of the active space, I think a lot of my clients have lately looked at index inclusion, what, if anything, they could do to qualify for additional indices. And sometimes that's, connected to ESG ratings and, whether there's anything you can do about it in the short term. I think it's worth doing this exercise and just seeing whether you can encourage additional passive flows into the stock that way.
So have you seen any examples where analyzing shareholder concentration or style mix led to a real strategic shift in how a company approached their investors?
Well, I've got a long-standing European telecoms client, and like many of their sector peers, they went through quite a challenging time for a number of years, prior to COVID. And along some of the sector dynamics, they had a couple of corporate governance issues along the way. So what that meant is that international investors, and they initially had quite a number of US investors who, for their size, were quite large investors. They gradually exited the stock, and suddenly domestic investors who understood the market dynamics and could see the potential in the company, suddenly they were left holding about 60% of the issued capital. Now, initially, I think the company didn't feel there was much they could do about it until the tide had started to turn. So once the performance started to improve, then they consciously devised an engagement strategy targeting specifically UK and continental European investors. Initially, they felt that US investors would be more of a challenge, so they were sort of phase two of the approach. But that was clearly driven by looking at where they are today, where they want to be, and also I think being able to, I think, get back to paying a more attractive dividend. So not only looking at some of the geographic concentration, but also maybe being more attractive to some of the income investors that would have either stayed but reduced their allocations or exited the stock.
So thinking about that regions that you mentioned as well, when you look at the shareholder base, how can you spot untapped potential in regions where your company doesn't yet have strong ownership?
I think this is where peer heat maps are gold. If you see that some of your peers are successfully attracting, whether it's Benelux ESG funds or, Japanese pension funds, whatever it may be, if others are having more success than you, then, that's worth a look. And, often you'll find that, some of the barriers might be quite small if you adjust, the time when you hold your results call, some of the reporting format, change some of the nuance in the language in your reporting, you make it a lot more accessible for some of these investors. So I think that sort of analysis really helps in finding new opportunities.
Yeah, so I think, what we have seen here is that by analyzing your current shareholder base, you really do gain a clear understanding of where you're strong and where gaps may exist. I think the next step is then to look forward and outward at benchmarking against your peers to uncover new high potential investor opportunities. So in studying your peers, you want to be able to understand who invests in them and not in you, which investors are increasing stakes in the sector, and are there any funds that are rotating out of competitors that you could approach? So Sandra, when you're looking at peer analysis, it can get very data heavy. What's your advice for cutting through that noise and focusing on insights that actually change your targeting strategy?
I mean, I like to use global targeting as, something that informs your strategy overall, but then decide on a sort of more manageable number of financial centers to tackle in each phase. So I think once the big analysis is done and you're left with thousands of, potential hits, if you decide that actually, realistically in the next 12 months, management can make it to these 3 locations, and then you drill down specifically into targets in those, that's a less scary exercise than trying to decipher the entire global targeting report. There's also, I think, management might be in Frankfurt for a conference. So rather than setting aside, 2 days for a roadshow in a new location, you might just want to, add on a few meetings into their schedule when they've got a few hours free. That's a pretty low risk strategy for expanding your shareholder base and not sort of having management travel before you've done, a lot of, research into, some of the targets. But also, I think looking again at engagement data and any other insights you might have, looking at, I think, who's, as you mentioned, who's coming into, some of your peers and trying to understand why. Whether you have some of the same characteristics or whether they're buying them for a completely different reason, and although it sounds like in theory a good target for you, in practice these are not the not the funds that you're likely to attract in the short term.
So I guess also getting the right peers is obviously going to be really important. So how far beyond the obvious peer group do you think IR teams should look? And what's the right way to define a useful peer set in the first place?
I think by this point, I think the majority of the companies out there have sort of gone beyond just the traditional sector peer group, which was for many years, I think, the sort of standard practice. I think if you're struggling to define who you should compare yourself against, I think this is where feedback from your existing shareholders can help. So, why do they hold you, and who do they compare you against? So, if you're unsure, some of the insights you get from existing shareholders can help. Otherwise, looking at some of your fundamentals, how fast is revenue growing? Are you, profitable? But also, market cap, dividend yield. In addition to including some of the direct peers today, I'd say look at aspirational peers, some companies with similar characteristics who are perhaps a little bit larger than you. So I think all of these can help define a peer group, and then run an analysis, see what you get, run it again, change the the different comps you've got in there until you've got something that makes sense. And I think trying to reach out to some of these investors will be a very good test as to whether you've chosen the right peers.
Yeah, and I think that's a really great point in terms of looking at a different set of peers. We've actually had quite a number of our clients do those exercises where they look outside of just their sector, because obviously we know that some investors might have already chosen what their sector play is, and that you might be sitting outside of that. And I think when you can look at especially things like fundamentals and those aspirational peers, it enables you to go to those investors with a different set rather than just saying they're in my sector, they're my sector peers, and therefore you should be interested in me. So I think you raise a really strong point there as well. So benchmarking against peers, it reveals where those new opportunities exist and which investors are already, active in your space. Um, but with these insights in hand, the next step really is to turn that intelligence into action by building a targeted prioritized investor list. So here on the screen, we've got a couple of highlights of the tiering that you can do. The high conviction tier ones, the tier twos that are maybe strategic, but they're just a little bit smaller or niche, and then the tier threes, which are more so the passives or maybe the retail focused investors. So Sandra, once you've gathered all of this intelligence, what's your approach to prioritizing these targets? How do you separate maybe the must-haves from the nice-to-haves?
I like to use three filters in this context. I think, first of all, look at the fit, whether they invest in your type of story based on the size of their holdings in relevant peers and some of the recent trading activity, but also in practical terms, access. Are you able to gain traction with them? Can you get through to them either directly, via brokers, via IR advisors? Sometimes we know that, a certain institution is a really good match for us, but we just have a lot of difficulty in actually getting through to the relevant fund manager. And then its impact, looking at your own shareholder base and how you're seen, whether the investor you're looking at is likely to move the needle in terms of perception or your liquidity. And every sector has a number of investors that act as influencers for the rest of the industry. So attracting one of those is going to have a bigger impact than some of the others potentially.
And so how much do you think about diversification, for example? So blending traditional long-only funds with niche ESG or thematic investors when building out a list?
I think in the same way as sort of investors look at building an optimal portfolio for them, I think companies should be looking at adopting this approach when they're building an optimal investor base. So you want to get some balance, stability from long-only funds. You might want to get some momentum from either sort of ESG or some thematic funds. You might get some liquidity from retail. So think about the role that each of them is likely to play, and then once you've got a diversified shareholder base, I mean that's your best defense against volatility in the markets.
And so if we bring it back to, a geographical perspective, what's your advice for prioritizing between domestic and international targets? How do you decide where to focus on first?
Well, I always say start at home, where your story is most easily understood. It's a natural fit. And then I think once you've got consistent performance, you've got a certain profile in the local market, ideally you've got some analyst coverage. I think that's a good time to then reach out to international investors, because you'll have the proof points, you'll have local investor buy-in, and this is a really solid platform to build on.
So, and I think you've shown that, building out a thoughtful, prioritized target list really gives your strategy that focus and direction. But identifying the right investors is really only just that first step. The real impact comes from how you then start to engage with them. So that's what a clear outreach plan becomes really essential. Investor targeting is not just about research. As we all know, it's really about that relationship building piece. And here on this slide, we've highlighted some of the areas that we all know about the outreach that we can do and what it includes. So, Sandra, what's the biggest mistake that you see companies make when they shift from that research piece to the outreach, and how can they avoid that?
I think the classic mistake I see is companies sending a very casual email with the same deck to about 100 investors stating that, management will be in town on, these dates, offering a meeting. I think it's really important to understand that this initial approach email is really a sales exercise. So, often crafting your investment case in a format that fits into this email, that hooks the reader, within a few seconds of opening the email, but also gives them enough depth to understand that actually this is a really interesting opportunity. I mean, that is harder than, writing a 10-page report often. So I think making it more tailored helps as well, doing some research. And, if you've picked a certain investor target based on a number of different criteria, put that in your email as well. Say, we've seen your allocation in company X. We think that, we might be, aligned to your investment strategy, and, here's why. So I think that level of specificity can open doors more than, just a casual email with a standard deck.
Yeah, so if we think about I think on the previous slide we highlighted, for instance, the high conviction investors. In your experience, what approach works best to break through to those types of investors who potentially could already be quite heavily courted by, your peers already?
I think this is where your management team comes in, and their ability to deliver differentiated insights, talk about what its margin levers, regulatory tailwinds, long-term transformation, just, I think, deliver the story in a very engaging way. And so it's those senior level conversations that will make or break, whatever you're trying to do. So I think preparing your management team to deliver exactly what the investor needs is critical. And I think this is where IR teams should do their own homework and understand what the investor is looking for, relay that to the management team, spend some time rehearsing them. So make sure that once they go in, they're fully prepared, they know exactly what to say and how to say it in order to win the investor over.
Yeah, and I think that really brings together what you mentioned before with that feedback loop as well, because being able to understand what they've said previously really feeds into that preparation as well. So, outreach across the different markets often comes with different expectations as well. How do you adjust your approach when targeting or meeting investors across those different regions? And are there any cultural or market nuances that really matter?
I think tone does matter, and being aware of cultural nuances is important. So, knowing that I think US investors, for example, will expect sort of clarity and conviction, going into a meeting, that, Europeans might be more balanced and maybe more focused on sort of governance, ESG. Asian investors will take longer to build a relationship. They might need more consistency, more long-term, follow through. So understanding, doing your own homework, understanding sort of what each of them expects, both more broadly, but also specifically, looking at each individual investor within each of these markets, and then, gathering as much data as you can, talk to other IR teams. Many of my clients are on, WhatsApp groups with other people, who are covering IR within their industry, or, people they used to work with. So I think we all have networks we can tap into and ask for advice. Has anyone met, this investor before? What are they like? What do they like? So, ask your peers, ask your banking contacts, your existing shareholders, but also I think reach out to investors before you meet them and find out exactly what they would like to get out of the meeting. So, let them take the lead and tell you what they need and, how they want to run the meeting. So, don't feel like you have to sort of guess and sort of just go with your instincts.
And do you think that digital channels like webinars or virtual roadshows are leveling the playing field for international outreach, or is in-person still king?
I mean, look, digital channels have certainly democratized access, but I think trust still gets built in person. So, virtual meetings are great for reach, for efficiency. I often have clients who, they might be in New York for, a couple of days for investor meetings. And, either meeting will get cancelled and they can't fill the slot with another in-person meeting short term, or, they might just not have enough demand during a certain part of a day, but they have an investor in Sweden, for example, who's really keen to have a Teams call with them. So I think if you've got management already setting aside 2 days for investor meetings, use every gap you have during an in-person roadshow to fill the slots with, some of the some of the virtual meetings. Virtual is also great for routine catch-ups. So, if you've got shareholders who know you really well, there's nothing particularly controversial in the last set of results, but they want to clarify a couple of things, just ask a few follow-up questions, and then, Teams, Zoom, and that works really well. But, if you're talking conversion, then I think, physical meetings are still critical. So I'd say, take a hybrid approach, use virtual meetings to open doors and keep people updated, and in-person roadshows sort of to close the deal.
Yeah, so and I think that, when we're executing a target outreach, that's when, people's strategy really does become real. But of course, we know that that is not where it ends. It doesn't end with the meeting. So to continuously improve, you need to track how your investors engage and use those insights to refine your approach. So, after the outreach, you want to be able to track who engaged with you and how. Did they attend the meetings or events? Have they requested follow-up information? And this feedback loop really helps to refine the targeting strategy over time. And performance indicators should be a blend of financial and non-financial metrics. So, Sandra, when you look back at outreach activity, what engagement signals do you pay the most closest attention to? The ones that actually really give predictive future investment.
Look, I like to watch follow-up intensity. So, how detailed are the follow-up questions? Um, Is the investor in regular attendance at your results presentations, other events? Have they sent the junior analysts? Are more senior members of the team dialing in here and there? Are they accessing the website to the extent you can tell from your engagement statistics? Have they put you in touch with their ESG team, and have they sent in a questionnaire? So I think some of the meetings will create more momentum than others. And this is a clear sign that they're seriously evaluating you as an investment opportunity.
And can you give us an example of a time when feedback from investors fundamentally changed a company's targeting approach?
I had a really interesting one on this. I was doing a perception study for a client in the investment management space, and a couple of investors, we spoke to mentioned that a major investor in the space was negative on the company, and that their buy-in was critical for sort of turning sentiment towards the stock. So identifying this, influencer, if you like, and their level of impact really refocused management attention. And, for a period of time, more time and effort was spent trying to win this, one investor over, rather than traveling around the world and trying to target lots of, different investors that, maybe would have come resulted in the same outcome, but would have taken a lot more time. So I think this is a clear example where I think less is more, and that sort of a more targeted and more specific approach can actually get you the results you want better than traveling the world. Another example I've seen was poor ESG ratings affecting company attractiveness, and existing shareholders coming back to say, actually, if the company could do something about these three things, that could significantly improve their ratings and make them more attractive to the market as a whole. So I've seen a couple of clients make a few tweaks, and sometimes it's a longer term project, but in many cases, there's low-hanging fruit out there that you can address. So that opened the door to, also proactively targeting funds that wouldn't have been interested in the stock previously. So not only did it sort of make them more attractive, but it allowed them to then go out and think about targets in that space as well.
And so you mentioned, a longer term project and a tweaking along the way. And we know that creating a targeting strategy, implementing it, outreach, it takes a considerable amount of work. How often should teams revisit and refresh their targeting strategy? And what usually triggers a rethink in your view?
I'd say at least once a year, or anytime your strategy or leadership changes. But also, if you typically go on the road twice a year and dedicate sort of a considerable amount to meeting investors and trying to expand your shareholder base, then I'd say it makes sense to refresh your analysis before you do that. Um, because I think markets evolve, and often markets evolve faster than IR calendars. So I think it's worthwhile looking at who you're reaching out to.
Yeah, and I think you've said quite a few times, like through some of the answers that you've given, that looking holistically at more data that they can that IR teams can get is also really important. Analytical data, engagement data. So, have you seen cases where such engagement data has prompted a rethink of which geographies or investor types to focus on, and what did that pivot look like?
There was an interesting case where a client of mine held a virtual ESG day, and they noticed unusually high engagement from Scandinavia after the event. So they decided to follow up with a roadshow in the region, and sure enough, secured their first ever active holder in Stockholm. So I think looking at especially events where people are registering, putting down their data, it's often straightforward to work out who's watching, and then marrying that up with any other information. I think this space is evolving, and you're getting more and more information, and companies that are more active on LinkedIn, for example, will get a lot of engagement statistics, and can also proactively use such channels to target potential investors alongside direct engagement.
And do you think, are there any differences in how international investors engage compared to domestic ones? And how should IR teams interpret that?
Look, I think the relationship with domestic investors and some of the communication is often more direct, it's more casual, it's just easier. You see them around at different conferences. They're around the corner, they're more willing to just pick up the phone and just, call you and, ask their questions. So it's they're a little bit like, friends from school, and, you keep seeing them periodically. I think with international investors, because they're further away, there might be a language barrier, whatever it may be. So, you'll often get emails rather than phone calls. So they might prefer to engage digitally. They might prefer to go through intermediaries, so, contacts that they know. So it can often look quieter, even when they're looking at you and following developments quite regularly. And also, if you want to keep front of mind with these investors, you often have to try a little bit harder. And, I think of this as sort of scheduling date nights after 20 years of marriage to keep things fresh. So, whereas, your domestic investors are, casual and on the phone every other week, with international investors, you have to be a little bit more intentional.
So you spoke there about some of these different tools that are out there. Which tools outside of direct engagement can companies use to enhance their effectiveness when, targeting potential investors?
Look, over the last few years, a number of my clients have used LinkedIn, paid for LinkedIn campaigns to support some of the engagements that they were doing. And, this works also within some of the transactions that they've done. Surprisingly, it made it past the lawyers. But, they would look at institutions that they would like to target. They would either develop, or they would already have some relevant content that they can distribute via LinkedIn. Maybe a short video, whatever it may be. And they would target this content at, everyone who's got the right title at the right institution. So, you can't narrow it down and target specific people, but you can do it in a specific enough way that it gets to the right audiences. And it's pretty cost effective as well, because it's not a massive universe when you, I think, specify exactly which institutions and which type of roles you want to target. And I think the other thing that is worth mentioning is just some of the traditional media profile raising. And, I've had a newly listed client who was raising their profile following the transaction during that sort of first year post listing. And they intentionally sort of did, a few media interviews in specific markets where they felt that there would be investor demand. And that put them on the map with, a couple of, for example, in one case, it was a family office in Spain. And, they had a good meeting. The investor bought some shares. They told, various contacts of theirs across the industry. Suddenly they started getting incoming requests from, other family offices in Spain. So I think it's worth considering how broader communications efforts can support and sort of magnify some of the direct engagement that you're having.
Yeah, and I think we're seeing quite a lot of different IR teams really lean into those different ways of communicating to the market, especially as we have so much more at our fingertips. And I've seen a lot of that with some of the awards with that are being handed out globally about how more IR teams are getting results from that. So I think all of those are really good points. So, for maybe my last question to you for today, if you were starting from zero, so I know this is probably going to be quite a big question, and you had to build an international investor base, how would you design that strategy differently from how most companies still approach it?
Well, I think this would give us the opportunity to really build it like a portfolio, sort of intentionally with balance. And, I'd start with asking, so what kind of ownership base, we'd like to have in, let's say, 5 years' time. And then think about stability, liquidity, visibility, valuation, and use that to define sort of the right mix. So maybe you have some domestic holders who will have sort of conviction in your story and can sort of be the foundation of your shareholder base. Then some international long-only funds that will give that will bring a lot of scale and more sort of assets under management, some thematic ESG investors for momentum. So I think that would be sort of a really nice starting point, and sort of, you know, putting together a wish list, but then also using engagement data to see where interest already exists and sort of leveraging that, because, you know, if you're building something from scratch, then I think low-hanging fruit is always good. And then I think in terms of engagement itself, rather than sort of building a traditional roadshow calendar, I probably look at it as a sort of rolling campaign, sort of light, frequent touch points to build awareness, and then, you know, followed up by targeted in-person meetings once the familiarity is there. So I'd say, just, you know, if anyone on this call is starting from scratch, then I'd say try and build a shareholder base that sort of truly fits the company's strategic DNA.
Thank you, Sandra. So that brings us really to the end of our time today. So I encourage, if anybody has any questions, please do pop them into the Q&A while I just wrap up today, and then we can go back and we'll have a look if there are any. I think one of the key things that I really felt today that you were talking about, Sandra, was not to be afraid of asking questions and reaching out to investors, you know, be it at the end of a meeting to be able to get feedback, to be able to understand what their sentiments are, how they're perceiving the company, you know, from the company story point of view, from a targeting perspective. Are they on the right track? Is there anybody else that they can speak to as well? And I think then also being able to reach out to them to understand, you know, what is it that they want to talk about, you know, in terms of the prep point of view. So really not being afraid to reach out to them and use them as part of your process as well. And then I also felt the second points that you were making is there's so much more data available to everybody when they are looking at targeting, when they're looking at speaking to their investors. So that data management piece, the knowledge management piece, really trying to bring in all of the data that you have to hand from your websites and your events, the feedback loops, everything, because all of that really lends into how people are behaving, how investors are ingesting your information. What are the extra geographies that are out there that could be tapping into you that you're not quite aware of yet? And we're all very busy. We don't have time to analyze all this data ourselves all the time. So making sure that you've got the appropriate ways of being able to gather that information as well. So I think we might have had one question here. So we have a question from Katie, and I think I've got the question here, Sandra. So I'm just going to read it to you so that you can answer it. It says, would you recommend reaching out to investors after a conference roadshow and asking for their feedback through email instead of in person during the meeting?
I mean, look, I think you can do both, depending on the dynamic during the meeting and how much time you have, and you know, if they have lots of questions, obviously the priority is on answering those and letting management tell the story. So if it's going to disrupt the flow during the meeting, then by all means follow up and, you know, email them. I think you have a little bit more of a risk of not getting a response when you follow up via email. Then I think if you catch them, you know, during the meeting or as you are walking out, if, you know, you have an opportunity to casually ask, you know, a couple of questions, then you know that you'll get a response in real time. So I think either is fine. I think you play it by ear and see, you know, whether the opportunity during the meeting is there or not. But also I think if you're following up by email, you can ask a few more detailed questions. I think in the meeting you might keep it to one or two, whereas by email, you might put in, a few more. But also I think, I mean, the third option is to try and follow up by phone as well, the good old traditional means of communication. Pick up the phone, ask whether they've got everything they needed, if there's anything else, and ask your questions at that time.
Thank you, Sandra. So I don't think we have any more questions for today. Sandra, I'd love to give you a moment to maybe give us some closing thoughts that you might have.
Look, I think investor targeting really isn't about chasing holders. It's about understanding intents and aligning your story with, investor behavior, regional nuance. But it's also, I think, not all about AI and data. I think in the context of the discussions that we keep having about the various tools at our disposal, we can often forget that actually a large portion of the markets, we're trying to address are still sort of human beings, at least in 2025. So I think that emotional connection and getting the story across in a way that touches something in the investors' hearts rather than, just delivers the right data is I think something that gets sort of forgotten in some of today's discussions.
Thank you so much for your time today, Sandra. It's been a really insightful discussion. Thank you to everybody who's joined. I hope you found it valuable. We will be sending out a recording as well to everybody so that you have that as well. Thank you so much and enjoy the rest of your day. Thank you.
Thank you for having me.